Welcome to Compliance Extra. I'm Sue Burt. In this segment, we're joined by Mark Miller, a compliance consulting manager with Wolters Kluwer Financial Services. Mark, the Flood Reform Act will be a big topic for financial institutions in 2014. The agencies issued their proposed rules back in October, and the comment period ended on December 10th. Can you give us an update on some of the main issues looking to be implemented in the proposed rules?
The enactment of the Biggert-Waters Flood Insurance Reform Act of 2012 on July 6, 2012 set in motion unprecedented changes to the National Flood Insurance Program. The law is ushering in sweeping reform of the flood insurance premium rate structure, flood hazard mapping, and floodplain management. However, recent legislation has delayed the implementation of many of these provisions until further affordability studies can be completed by FEMA. At the same time, the law made significant changes to the lender flood insurance compliance requirements. Motivation to reform the National Flood Insurance Program is well intended. The need for financial solvency and stability of the federal flood insurance program has never been greater. As we've seen in recent weeks, these changes will have some profound effects on consumers, real estate markets, and of course, lenders charged with making sure borrowers purchase and maintain flood insurance. So let's take a look at the highlights of the proposed rule. Private flood insurance, mandatory escrow requirements, and forced placement. One of the goals of the Act was to encourage greater private sector participation by requiring lenders to accept private flood insurance or flood insurance coverage that is not backed by the NFIP. Unfortunately, as pointed out by a few industry organizations, the definition of private flood insurance included in the Act could pose some significant compliance challenges for lenders. The proposal requires lenders accept private flood insurance that meets specific standards defined in the Act, including coverage that is at least as broad as coverage provided by a standard NFIP policy. But few lenders today have the capacity to make these kinds of determinations. The agencies have left a safe harbor under which a private policy would be deemed to meet the statutory definition of private flood insurance if a state insurance regulator makes a determination in writing that the policy meets the definition. But again, the question becomes, do state insurance regulators have a mechanism for this? The agencies are also considering including in the final rule a provision expressly permitting discretionary acceptance of private policies that do not meet the statutory definition of private flood insurance if the policy meets certain standards and requirements. We know many industry associations have responded with comments and alternative solutions. Now that the comment period is closed, we'll have to stay tuned to the final rule. There is still a lot of work left to be done on this topic.
Thanks, Mark. Let's move on now to the topic of mandatory escrow requirements. What can you tell us?
Sue, the proposed rule generally would require banks or servicers acting on their behalf to escrow premiums and fees for flood insurance for residential improved real estate or mobile home, securing any residential mortgage loan outstanding or entered into on or after July 6, 2014, unless the bank qualifies for the statutory small lender exception. The timing requirements for establishing escrows are different for new loans versus outstanding loans. Under the current proposed rules, loans requiring flood insurance that are made on or after July 6, 2014 would be required to begin escrowing upon loan consummation. The rules would also require banks to mail or deliver a written notice informing borrowers of the escrow requirement at the time they provide the general notice of flood insurance requirement. So, we will see some new disclosures as a result of this rule. The proposal includes a sample of this notice in Appendix C. For loans that are outstanding on July 6, 2014, the escrow process and timing for required disclosures is a little different. Banks must provide notice at least 90 days before they must begin escrowing. The timing for outstanding loans is intended to alleviate the potential burden of the new requirement on lenders and borrowers. Appendix B contains the sample form of Notice of Requirement to Escrow for Outstanding Loans. There is a small lender exception in the proposed rule that states, unless required under state law, a bank is not required to escrow if it has total assets of less than $1 billion in either of the two preceding calendar years, and, as of July 6, 2012, was not required by federal or state law to escrow taxes or insurance for the term of the loan and did not have a policy to require escrow of taxes and insurance. If a loan is sold by a small lender to a lender that is not subject to the exception, then escrowing must start with the first loan payment on or after the first renewal date that is at least 6 months after the transfer date. Escrows also would not be required if another lender already has an escrow account on the property or if the policy is through a common interest community such as a condominium association. Finally, What good would a discussion of flood insurance be without talking about forced placement? Pursuant to Section 100-244 of the Biggert Waters Act, the agencies have proposed amendments to the regulation to clarify the current forced placement provision, specifically when a lender may begin to charge for forced placed insurance. The proposed amendments permit a lender to charge the borrower for the cost of premiums and fees incurred beginning on the date on which flood insurance lapsed or did not provide a sufficient coverage amount. It also provides clarification that the term date of the lapse is the expiration date provided in the policy. Another area addressed was the circumstances under which a lender must terminate forced placed insurance and issue a refund of the borrower payments. The agencies propose within 30 days of receiving confirmation of a borrower's existing flood insurance coverage. And thirdly, what documents are sufficient to demonstrate that a borrower has flood insurance? Again, the agencies propose a declarations page that includes the existing flood insurance policy number and the identity and contact information for the insurance company or agent. While the industry associations welcome the proposed clarifications around these topics, there are more clarifications needed. Industry associations have submitted their comments and suggestions. For example, is a declarations page always sufficient enough to demonstrate adequate coverage? Are there other documents lenders and borrowers can use in place of a declarations page? Can it or should it be the lender's right to determine that the borrower's policy satisfies the mandatory purchase obligation before canceling the forced place policy? All of these answers and more coming soon in the final rules.
Mark, thank you for this informative update on the proposed flood insurance rules. For more information on our settlement services and flood insurance solutions, click on the link below your video screen.